Hi everybody, welcome back to the channel. My name is Miro Svoboda. I'm the host of Easy Retirement with Miro, and I have some really exciting news today. We have a new acronym for you, the FHSA, which is the tax-free first home savings account being introduced in 2023. Available to most Canadians. It'll be another option to create tax-free pool of capital for you. In today's video, I wanted to share with you the basic features of the FHSA and how to use it to your advantage. Well, first of all, anybody who is age of majority can open the FHSA, but also there are a couple other stipulations. You must be a Canadian resident, and you also must be a first-time home buyer, which the definition of the first-time home buyer is anybody who has not owned a principal residence 4 years prior to the year in which the FHSA is being opened. So in reality, you could have owned a home before, you could own principal residence before, you could have owned a rental property. It's just that you could not have owned principal residence 4 years prior to opening. Now, the exciting news is that contributions to the FHSA will be tax deductible. Just like RSPs, every dollar that you contribute to your FHSA will be completely tax deductible. You will have $8,000 maximum per year, $8,000 annually, up to $40,000 lifetime. Now, the other thing is to keep in mind is that your contribution room will only start to accumulate once you actually open the FHSA. And just like a TFSA, the FHSA will provide or will offer tax-free growth. So anything that you put, any funds that you put into the FHSA, just like a TFSA, will be growing on a tax-free basis, and all of your profits will be tax-free while the funds are invested, and also when you pull funds out of the account. So let's talk about withdrawals. First of all, obviously the FHSA is targeted towards purchase of your first home or your principal residence. So when you withdraw funds to buy a home, all of your withdrawals are completely tax-free. But what happens if you decide not to go ahead with that purchase? Well, another option is to transfer these funds to your RSP or RIF. And again, this would be a tax-free transfer to your RSP or a RIF. And the last option would be just simply pulling cash or pulling funds out from the FHSA for other purposes, and this would be a taxable event. So similar to an RSP, when you're pulling funds out of the RSP, you are taxed at the highest marginal tax rate. Same idea with the FHSA. Now, the other features are that once you do purchase a home, there's no further contribution room generated in the FHSA. And unlike RSPs, we do not have the first 60-day contribution room, meaning you can only tax deduct in the year when the contributions were made. For over contributions, the CRA will assess a 1% penalty, 1% per month penalty, and your deductions, just like with RSP contributions, you will be carry forward undeducted contributions indefinitely. So what this means is, let's say somebody opens this account very young and is in a fairly low tax bracket. Well, you can make contributions, but you don't have to tax deduct these contributions until later in life when you're actually in a higher tax bracket. Similar to an RSP, same rule. As far as qualified investments, again, very similar to RSP, TFSA. Pretty much any investment that is eligible to be held in an RSP or a TFSA, you would be also able to hold that investment in FHSA. So mutual funds, ETFs, individual stocks, and many other securities will be eligible to be held in the account. Okay, last couple of points regarding the tax-free first home savings account. The FHSA must be closed 15 years after opening. So the account can only be open up to maximum of 15 years or age 71. So there is no age limit on opening. You only must be age of majority, but even later in life, if you have not owned principal residence for 4 years, you could open an FHSA, but the account must be closed in the year when you turn 71. You can also appoint a successor holder. If you have a spouse and your spouse is a successor holder of the FHSA, should something happen to you, your own FHSA will roll over into your spouse's. And again, in spousal situation, you could gift, similar to the TFSA, you could gift funds to your spouse or to anybody for that matter to fund the FHSA. In regards to tax deductibility of loans, if you were to borrow funds to invest in the FHSA, you would not be able to deduct the interest incurred on that loan. And this is different from RSPs. There is no bankruptcy protection with the FHSA. We're excited about this new option for accumulating tax-free capital, the FHSA. Hopefully I was able to add some value today. Please subscribe to the channel. We'll be releasing videos on a weekly basis. Thanks again for tuning today and have a great day.